So yeah, Posse, thank you for that great introduction. So yeah, I'm with Springline Advisory. We are a tax and accounting firm located in Indianapolis, Indiana, where we mainly focus on helping, our main focus for our team is helping clients that are located outside of the U.S. coming into the U.S. and expand their U.S. operations. So as Posse alluded to, we did go through a rebranding here effective June 1st. So we're fresh into that rebranding. So I apologize if I do say BGBC, but we are known as Springline Advisory now. So a little bit of a backstory is in 2024, we had private equity come in and invest in our firm. Where we were able to become a founding member in Springline Advisory, where we were able to consolidate with several different US-based accounting and tax companies, where we're able to go from 80 individuals in our Indianapolis office to roughly 600 individuals now across the US. And you still have the international tax team that I'll show here up on the board here shortly, but we're able to really expand our reach that we're able to provide our clients. So a little bit about us. Like I said, my name is Tyler Barton. I'm a tax manager. I focus mainly on helping clients with their day-to-day tax compliance and consulting and help navigate that U.S. tax market because it is such a complex and interesting market where there's a lot of things where if you do something incorrectly, there might be some compliance issues. There might be some severe penalties or problems down the line that you need to consider. Some other individuals here, unfortunately, they are unable to make it today. They left Saturday afternoon U.S. time, but due to some travel delays, they are still stuck overseas and won't be getting here until tonight. So unfortunately for them, they're turning a 14-hour travel day into 72 plus hours. But we have David Rickard, who's a partner with our firm. He is part of our client accounting services department, helping with, the U.S. payroll, U.S. accounting system, looking at HR strategies, helping clients expand into that market. So I will be covering his part of the presentation today. So we'll talk a lot of high level about U.S. payroll and those items. But if you do have any specific questions at the end, there will be a QR code that you can scan to connect with him if you want to dive further into that information. We also have Brent Holman, who's a partner who oversees our international tax practice, who does that high-level consulting, oversees the department, that final signer on the return, and provides that consulting at the partner level for inbound, outbound transactions, deferred tax calculations, and transfer pricing. We also have Kylie Egendorfer here, who is our client service specialist. She helps onboard our clients, gets them familiar with the firm, gets them connected with the right team members, and really helps exemplify our exceptional client service that we provide. So when entering the U.S. market, successful U.S. expansion is operationally driven, not just legally driven. You need to consider, why do companies enter the U.S.? So entering the U.S., it can be very complex, and it can be complex and a lot of intricacies that need to be considered. But when entering the U.S., you are expanding your client base. You are able to sell to more individuals, more businesses. You're able to tap into different talent pools that you didn't have before. And you're really able to watch your company grow. There are several common expansion paths that need to be considered. Are you going to go into the U.S.? Are you going to have individuals be coming over from Finland into the U.S. to work? Are you going to be setting up a U.S. subsidiary and understanding those considerations as well? And having an idea of what you're going to be doing to be able to make those early operational decisions. Because like we'll talk about later and mention several times, there are issues that you can run into in the U.S. that, doing certain things may trigger something that you're not aware of. Penalties in the U.S. with international complexities are quite severe and can range from $10,000 to $25,000 per instance, to where you can run into some issues where if the IRS or local state agencies catch on to anything, as well as if you're going through due diligence, that might be areas that get honed in on when trying to determine a purchase price. Like I said, the U.S. market has a lot of opportunity, but there are the complexities that we will go through in this presentation. A lot of things to consider when going into the U.S. is, what's going to be your entity setup? What is your hiring needs? What are your operations? When are you going to start scaling? What does that scaling look like? And then, what compliance needs do you need? I will also say if you have any questions during this presentation, feel free to raise your hand and ask. We can talk about US taxes and compliance all day, and I understand that can get quite boring. So if there's anything specific you guys are looking for, feel free to ask, and there will be time to talk after the presentation. So in the US, it's not just one system that you're looking at. You do have the federal system overall, but then you are looking at each individual state as well. So there's 50 states, and then within that state, there is also local jurisdictions that need to be considered as well. I think the last number I saw, there's roughly 13,000 taxing jurisdictions in the US. So it's very hard to navigate that. And that's really what we specialize is helping our clients navigate that and know where they need to file, what they need to be aware of. Because of those complexities, it's good to consider what payroll software you want to use, what payroll considerations you have, because when you're expanding into different states or different jurisdictions, you can get payroll fragmentation where one payroll company might provide services for one state, not necessarily the other, to where you're kind of having to piecemeal a lot of stuff. So there's a lot of considerations that go into that. There are also state labor specific laws that each state's going to be different depending on the rules and regulations for that specific state. So if you have an employee in one state, there might be different laws that they have to abide by in another state as well. We do have a sales tax in the US. It's very similar to the VAT tax here. I'll talk more about that later. But having employees in states can make you susceptible to sales tax, which might be different from the VAT tax. You might not even have sales in a state, but you might be susceptible to filing sales tax returns just for having employees within a state. Same thing with income tax. Having employees in a state can create income tax filing considerations, and it gets more complex now that remote work is more of a applicable item, that you have employees all over the US, you can really hire anywhere. It does create a broad scope of complexities. So some initial startups that you need to consider, what entity structure are you going to have? This is one of those items that it's good to know before creating the structure. What filing requirements does that create? What considerations do you need to know? Because that can really lead to some of those penalties that are $10,000 to $25,000. Your entity structure is something that is very important because you might look at it from one perspective, but not consider the other implications. So that's where we like to come in and just talk to clients before they form that structure to say, hey, you're going to have this structure, but it's going to create a certain tax filing that we will discuss later. And just what does that mean for the business, right? There's several different considerations. I'm a tax guy, so that's where my focus is, but there's several considerations on funding and other items. Other items to consider is formation of entity and obtaining an EIN. We'll talk about that later, but that is very important and required in the US. You'll have a lot of issues if you do not get that EIN number. You also want to open a bank account. Where do you want to open a bank account? What bank do you want to use? What considerations do you need to have for that banking, for your accounting system? What registrations are you going to have? Like I said, each state has their own rules and regulations. Each state might have different departments. You might have a Secretary of State that you need to register. You might need to register with the income tax. You might need to register for payroll. There's several different registrations, even at the state level, to where it can get very complex and compliance can be very costly and something that needs to be considered. What is going to be your accounting software? What's your compliance plans? What do you need as a business? And then just payroll and insurance considerations as well. What payroll company do you want to use? What insurance company do you want to use? It's not, insurance in the US is a big contention. It's an open market. And so there are different opportunities to go shop to the market to provide insurance to employers. It is not government run. I will ask, are there any questions so far? Okay. Some other consideration, audit requirements. In the US, there's no formal audit requirement for financials. When companies are being audited, it's either by a government agency looking into the numbers for tax purposes, or they're a public company, which it is required for public, but if it's private and they're being audited, it's for that tax agency, or it might be a bank or investors are requiring it. You're not required as a private company to audit your financials unless someone external vendor is saying that you need to do that. There is the sales tax, which we'll go into more later. But then you also need to consider, what are your capital requirements? there is no specific capital requirements in the US, but you need to figure out how is your entity going to be structured. Are you going to go to the US and get US investors, and that's where all the investments are going to be, or are you going to fund that from a entity outside of the US? Good things to consider, these different tax filings, different compliance items, and that's why it's good to have those conversations early, just to make sure that you have all those considerations and know what each route is going to provide for your company. Employee laws and benefits is something that needs, yes.
Regarding the audit requirements, is it sometimes that the private equity forces you to fall in Finland when they invest? Just out of curiosity. Because in Finland it's common that they will.
You might, it's mainly for, you see it for bank loans is a lot of where the audits come in. There's a lot of governance in those loans that if you're out of compliance with those governance, then they're going to revoke the loan. So that's where we see if it's private equity, it's going to be mainly just they want the investments to be looked at. So it depends on the company. Audits in the US are also very costly. They're very expensive, minimum tens of thousands of dollars just to perform an audit in the US. So it kind of depends on the size as well. But it'll be up to the private equity if they want to have that audit done. Good question. Any other questions? So yeah, employee laws and benefits, it's just good to consider each different the states are gonna be different. So need to consider if you have an employee in one state, might have different laws in the other state. And then just benefits as well. You want to be competitive when going to the US market. What benefits can you provide to those employees that makes it competitive for them to want to work for you? And then another thing to consider is responsible party for EIN application. We'll go more into that here in the next slide. So in the US, the first step is you really form your entity. After that, you can get what's called an employer identification number. This number is required for everything in the US. This is, once you get an entity form, this is the very next thing you need to be doing because you cannot open a banking account, you cannot start payroll, you cannot do really anything else until you have this number. Some things to consider is if you have an officer that has a social security number, which is the individual identification number in the US, we can oftentimes get an EIN same day. If you do not, the application has to go through the IRS where you have to fax it. The IRS still use fax machines. So I was very surprised when I came out of school and saw we were still using fax machines. So yes, we do have a fax machine, but we can fax it in, but it often takes 4 to 6 weeks if you do not have that US social security number tied to the application. So that can be an issue, or if you're trying to open up a bank account and make payments to employees, to where you might have to wait 4 to 6 weeks, and that's something to consider because yeah, you can't just start making payroll payments the next day. Yeah.
You happen to know if the social security number expires at 1 years ago?
It should not. Yeah, once you set that up, it shouldn't expire. Correct. Yeah, so you have to be a US citizen to get that. You can't apply. Oh, you don't? Okay. Yes, that's more, yeah, probably more immigration, or they can maybe talk more on that, but you apply for your social security number, but once you have that, you're tied to the US system, and once you have that, you can apply for it. Yes, thank you for correcting me on that. Yeah. Yeah, that's a really good question. So it really depends on what state you want to be in. Mainly we see companies register in Delaware. That state is very easy to enter. The requirements to register and incorporate in Delaware are very minimal compared to other states, and then also the upkeep afterwards is very minimal as well. So it's cost effective to incorporate in Delaware. And then, yeah, there's not a lot of upkeep afterwards. There's also an incentive that you're not required to file in Delaware. Sorry. You're not required to file in Delaware if you're incorporated there. Most states, if you're incorporated, you have to file an income tax return, so it lessens the cost of compliance as well. So we see most companies incorporated in Delaware just because of that easy, low barrier to entry. California, we see a lot of clients operating California, not necessarily incorporating California. California is one of those states that if you are incorporated there, you do have to file in California. And so there is if you don't have operations in California, there's an automatic $800 minimum tax at the state level. There's also other filing considerations in California where there is more cost of compliance there. Delaware, once you're registered, you're done. You file an annual report there each year, but California is a little bit more labor intensive. So we often have clients incorporate in Delaware, but not necessarily, they can still operate in California. You don't have to be incorporated in the same state that you operate in. Good questions. Any other questions? So yeah, after you get your employer identification number, you're able to open up a bank account in the US. Your documents needed to open up that bank account are EIN, your incorporation documents, and then passport copies or W-8BEN. That W-8BEN is just certifying you're a foreign resident. This can be a contentious area or an issue that companies run into because large banks, it's often difficult for foreign individuals or foreign companies to come and set up a bank account. The larger banks have certain rules and regulations that the local banks might not necessarily have to abide by. So we have a lot of contacts with local regional banks that really expedite the process for our clients to where they can open up a bank account pretty easily, oftentimes within a few days of getting that EIN number. I've heard several horror stories where clients have had to fly into the US just to walk into a bank, sign a document, and then leave because the bank was requiring them to do that. Our local partners in Indianapolis don't require that we have around 100 Finnish clients that we refer a lot to these banks. They're very familiar with the Finnish community. Trust them. It's not a problem to where they have to come in and actually sign anything. Everything can be done virtually. With that also benefit is, unfortunately, paper checks are also still a thing in the US, to where we are located right across the street from the bank. So if you do receive paper checks, we can just walk that down and deposit it. So it really provides a convenience for clients that we see them enjoy because the larger banks don't really work with them as well as our regional banks. And we do have that connection as well. They're right down the street. We know the individuals working there. Other banking activities, now you're going to see ACH and wires. And then other additional considerations you might want to think about is, are you going to offer credit card, debit cards, or loans to employees? So looking at accounting matters, there's no formal bookkeeping requirement in the US. They just require that you keep a set of books. So there's no agency that you need to file your financials with. It's really filed with the tax return. There's also no formal requirement for invoicing. So it's really what works best for you and your company. Some other considerations you need to know when choosing an accounting system is, what is your software integration needs? What additional items do you need? And can you integrate that with your software? But also, what is the cost, right? Like, it can be very expensive and costly to have all these additional add-ons, but it can expedite the process. Who do you want to have accessing your financials? What controls you need to be putting in? And then also, what oftentimes these financials will roll up into a Finnish parent, and knowing, what are those reporting requirements in your month end so management can make those decisions. So yeah, we already talked a little bit about some of this stuff, but some other items to consider: your state selection, customer location when entering the US, where your customer's located. If you're going to the US, you want to hire salespeople, you want to hire them in an area that makes sense. San Francisco is a big tech hub, so there's a lot of technology in San Francisco, so you might want to hire salespeople in San Francisco. Also, talent access, what are those talent pools, knowing where, different cities might specialize in different items, and knowing where you can get different employees just to be able to expand your talent base. Then we talked a lot about all this other stuff, but just considering their tax investments, your cost structure, where is the investments going to be coming from? How are you going to finance the U.S. entity or your U.S. operations? And just know that as well. Any questions? Okay. So when you're hiring employees in the US, you really create two requirements. There's the operational requirements and then also the tax complexities with it as well. On the operational side, once you hire an employee, you have to consider all these items. These are all required by state law and government agencies. And then you also have your I-9 compliance, where the employee has to fill out their information, and as a company, you have to collect that. On the tax side, as I've talked about, when you have employees, you're creating an income tax nexus. We'll go more into that later. But you start having tax requirements once you start hiring employees. It really starts ramping up the complexity, and remote work can expedite those complexities as well. Another consideration, we see people moving to the US, we get asked the question of, hey, we want to pay this individual. This is what we want to pay them. We want this to be how much they're going to have. What do we need to back into? Because there's all these other items that chip into that salary. So if you determine that they need $150,000 to live in a state, that's what the cost of living needs to be. If you just pay them $150,000, all these other items, the payroll taxes, health insurance, workers' comp, 401k match is going to eat into that to where that's not actually your true cost of the of the employee. So you need to back into that. We oftentimes will do those calculations to help clients understand what their actual cost of that employee is going to be. With having remote employees, it does create complexities. We've talked a lot about this, but other considerations, if you have an employee in a state, you're operating in that state. Regardless of if you're selling, regardless of whether you have an office, you will create a filing requirement in that state. With remote work, it also allows employees to where they can work in several different states. They may work in New York during the summer, but hate the New York winter and move down to Florida for 6 months. Because of that, they're working in 2 different states, so they need to withhold wages in both of those states and report that information, which it's good to track where your employees and know where they are or what they're doing, because if an employee might do that without letting you as an employer know, and you might be on the hook if you get caught or audited from the state. Any questions over payroll items? Okay. We'll dive into my favorite topic, the tax items. We'll see if you guys agree. But yeah, in the US, like we talked about, there is the federal tax overview. Going to talk high level about what that looks like. So most companies will incorporate as a corporation in the US. There are other entity types, but they are pass-through entities to where typically you want that tax to stop in the US. That's going to be taxed at 21%. Methods of accounting typically vary from cash to accrual basis. Those are the typical 2. You can choose other designations if approved by the IRS. And then in the US, there are certain rules to where certain tax adjustments that will get you to arrive at a taxable income. So we'll take the book income, make adjustments similar to depreciation, meals, certain payments have to be made by March 15th. Oftentimes we'll add back or take additional deductions on the return to arrive at a taxable income. So what creates a filing requirement in the US? Like we talked about earlier, having employees in the US does create a filing requirement. Once you form an entity, that creates a filing requirement in the US at the federal level. So in that example, if we incorporate in Delaware per se, you may not have to file in Delaware, but you do have a federal filing. So that is a surprise for clients that once you're incorporated, you do have to file. Even if the entity is dormant, you still have a filing requirement. It's still a 0 return, but there is a return that still needs to be filed. If you have an active trade or business in the US, that is a very vague term under the IRS's eyes. It's the purpose is that they want to be able to argue that you have a US business. Most of the time that comes into the play if you are operating from your Finnish company in the US, selling here, sending employees, what constitutes an active trade or business. Next is physical presence. So if you have inventory, fixed assets, if you're renting an office, that creates a filing requirement in the US as well. And then permanent establishment, if you're a foreign company that has employees here or you have an office, you have a filing requirement. At the state level, oftentimes a lot of these will trigger as well at the state level. Yeah.
Is there any risk that you as an individual might be required to file something using your director of the company or whatever, like registered as a party?
Like if you're, are you entering the US or are you?
If I, let's say I would be chair of the board or something of this US entity, but I still live and work in Finland, is there any risk that me or somebody like that would have to then file like personally something?
Not if you're in Finland. It really depends on how long you're in the US and what you're doing in the US as well. There's a thing called the, if you're sourcing income in the US, you likely have a filing requirement. But there's also a thing called the substantial presence test that depending on how long you are in the US, that could trigger a filing requirement. So if you are entering the US to do work, it's good to consult with a tax advisor just to know what activity you're doing and if there's going to be a filing requirement associated with that. But correct. Yeah. So we have officers that are registered on companies that are not located in the US. So it doesn't trigger a filing requirement for those officers. It's really mainly when you come into the US, you start working, spending substantial time here. That's when you're going to start sourcing US taxes. Yeah.
The tax agreement between the United States and Finland, you're not interested in paying double.
Yeah, so there is a tax treaty between the U.S. and Finland, and so it really depends on what services you're doing, where you're doing them, where you are a resident, a tax resident. The varying degrees, and that is something that we do is look into each situation on does that treaty apply, and we will talk a little bit more about that from the corporate tax perspective. But individuals do have that benefit of being able to lean on the treaty sometimes to be able to exclude income. There is also, if you do pay tax in either jurisdiction, there is a foreign tax credit in the U.S. to where you can offset some of that income. If you might be double taxed on a little bit of it, but there is an opportunity to reduce that with the tax credit. Good questions. Any other? Perfect. We already talked a little bit about corporate structure, highlighting just being aware of what that means in the filing requirement. If you have a lot of companies will come to the U.S. because they want the U.S. investments there, but they want to keep the intellectual property overseas in Finland. So they will have a holding company with the investments, but have what's called a controlled foreign corporation outside the U.S. That'll pull income into the U.S. That's something to consider. That if you do have a U.S. company that owns foreign operations, just knowing that can get pulled into the U.S. regardless of where that activity is actually occurring. We'll talk a little bit more about transfer pricing later. Failure to disclose intercompany transactions. So there is what's called a 5472 where you're reporting intercompany activity. It's trying to get at a base erosion tax so you're not moving income or expenses outside the U.S. It really comes into play where that tax is, I think it's 500 million worldwide sales. So not a lot of companies actually reach that threshold, but there is still an informational reporting requirement where you have to disclose that intercompany information. If you do not, it's an automatic $25,000 penalty per missed form reported, and it's filed per entity. If you miss a return and the IRS knows he needs to file that, they will send that notice out the very next day. And it is very hard to get rid of that penalty. Like I talked about, if you have a U.S. holding company that has subsidiaries outside of the U.S., it does pull in that income. That's where you see that necktie. It's formerly known as GILTI, if you guys are familiar with that. But it's really pulling that income in, being taxed at a reduced rate. There are opportunities to offset it with a tax credit, but it just surprises some clients when they're entering that U.S. because they want the U.S. investments, but they want the IP in Finland. You're going to pull that income into the U.S. There is also an opportunity for you to take an additional deduction. For foreign derived income, if you're in the U.S. selling outside of the U.S., you can get an additional deduction to where it can be lucrative to have contracts be based in the U.S. I know we talked a little bit about this, but getting more into like the tax treaty items. So if you are selling in the U.S. or operating in the U.S. from your Finland parent, there is an opportunity to file what's called a protective return or an 1120F, where you do go in and disclose that treaty benefit, the specific article, and say that it's being taxed in Finland and that the U.S. cannot tax that income. Now, what this also provides is whenever you are operating in the U.S., you're always mitigating your risk of a permanent establishment. You can never, if you're in the U.S., you're always going to have some level of risk of that. If the IRS deems that you have a permanent establishment, but you are following that 1120F, what it does do is it does start the statute of limitations where they can't look beyond 3 years. And it also lets you offset any expenses for any income and expenses in the tax years that are being audited. If you do not file that 1120F, they're just going to take your U.S. sourced income and tax it at 21%, no expenses. So it can be an area of exposure. That is an item that comes up during due diligences that they're going to ask about because it is just a great area of exposure, and they want to know if it's been buttoned up. Also in the U.S., just because there is a federal tax treaty, that does not necessarily mean that that applies at the state level. Each state's different. The tax treaty is between the federal U.S. and Finland, not the states. So each state's going to be different, as well as sales tax considerations. Any questions so far? Okay. Yeah, as we talked about earlier, having an employee in a state creates an income tax filing requirement. It can also create a sales tax filing requirement as well. Even if you don't have any sales in a state, you might have to file a sales tax return. And so how that works in the US is the sales tax is charged to the end user. It is a tax on the consumer, not on the business. So the business collects and remits that sales tax, but pays it back to the local jurisdiction. But they need to collect that from the consumer. And so where we see clients run into issues, and especially during due diligences, is that the typical sales threshold is about $100,000 for sales tax. It varies based off a state, but once you reach that threshold, that's when you need to start considering sales tax. If you do not collect sales tax, it is a tax on the consumer. But if you miss that and you go back and file those sales tax return, or the state comes and identifies that you are selling into their state, does an audit and decides that you need to pay that sales tax, it's difficult to go back and ask the customer for that sales tax, right? You don't want to go back and say, oops, sorry, you guys got to go pay 7% more on an invoice from 2 years ago, right? They're not going to appreciate that. So most of the time, if you're not collecting sales tax and you get caught or during a due diligence, they want you to go back and pay for that. It's going to be the business paying for it, not the consumer. Some sales are exempt in the US, but we do recommend claiming or collecting exemption certificates. These are collected from the customer saying that they are exempt, and then that means you don't have to collect any sales tax. There may still be a filing requirement, but it does help during audits if sales tax was not collected on those. Yes.
Same tax, if you sell on to someone, to end user.
It depends. If the business is the end user, there can be sales tax on that. And sales tax we have a whole department that knows all the intricacies of sales tax, but it depends on what's being sold, who's using it, where it's being sold. It's a whole nother, falls under that whole nother 13,000 taxing jurisdictions. And we have a department in Springline that focuses just on sales tax.
The main thing is, are you the end user, or do you sell on to some other company?
So there is if you buy a product and you use it, if you're the end user, you should be collecting sales. The company selling you the product should be collecting sales tax. There is an instance that we see if you are selling intercompany items and you're using that, if you're selling like a server or something, and you buy it if the US company buys it from the Finland parent and they don't collect sales tax, there might be what's called a use tax, where because that entity is the end consumer, it actually shifts to the buyer, and it's their responsibility to remit and sell. But that's typically, you typically see it more in your day-to-day sales. Any other questions? All right, so the one big beautiful bill, OBB, OBBA, there's several different variations, whatever you want to call it. But just want to talk about, point a few items out high level that we just see a lot of it impacting our client base, just so you guys are aware. I don't want to get too far in the weeds of these items, but one of the items that's kind of exciting is Section 174. Pre-OBB, if you were doing R&D in the U.S., that had to be added back and expensed over a 5-year period. Now it can be expensed immediately. You don't have to add it back. If it's done overseas, you have to add it back add it back and then expense it over 15 years. That foreign derived intangible income, that's that additional deduction if you're selling outside of the U.S., provides a favorable tax rate just to be able to have sales if you're selling outside of the U.S. That rate changed slightly, not a big change there. And then that guilty income, they just really changed the name to necktie. That's sometimes what they do with these bills, is they just change the name. Slight change in the rate. There was an additional deduction of 50% on this income. It now changed to 40%. The interest expense limitation might be too in the weeds here on this item, but there is if you're offsetting your income in the U.S. by a certain level of your interest expense, you used to be able to include that guilty or necktie income, which you cannot do that now. So if you are a U.S. holding company that has a lot of loans and really driving losses by those loans with foreign subsidiaries, you might not see as much of an interest expense allowed to be taken because it might be limited, because your income, if it's being driven by that guilty income, is going to be offset. So it's going to mess with the proportions. Some other items that are pretty exciting is bonus depreciation. So effective January 19th, 2025, you get 100% deduction on applicable assets and service after January 19th. So you get to expense those immediately. And then certain manufacturing factory semiconductors, these manufacturing, you're able to expense those 100%. Previously, they were going to be expensed over a 39-year life. So it's really driving to bring R&D and manufacturing in the U.S. That's where a lot of the driving of the updates on the OBB is. Some other incentive and tax planning opportunities, looking at if you are coming to the U.S., where are you going to be located? If you're going to build a factory, understanding that there are additional deductions and credits at local levels. So looking at if you're going to build a factory, build an office, ask that question, are there any additional deductions or opportunities that you can take in that jurisdiction? Or if you move down the street into another county, are there additional deductions as well? R&D credits, so you can get an addition. If you are doing R&D, you are able to expense those immediately, but you are also able to get an additional credit on top of those expenses. This is an after tax deduction, so it can be pretty lucrative to have R&D done in the US. There is also, we're finding the setup that if you you don't necessarily have to own the intellectual property in the US. It can still be located in Finland and owned by the Finnish parent company or subsidiary. As long as you're doing R&D in the US, if you have US employees doing R&D, that's really what they want to focus on. They don't necessarily have to have the property in the US. So you can still get that credit even without owning the intellectual property in the US. An item that we're seeing be honed in a lot on due diligences is transfer pricing. It's good to consider and understand what your transfer pricing policy is and where it comes from. And as your company grows, you need to update that. A lot of people will do transfer pricing internally for those first couple of years, might just do a 5% markup. Just want to keep it simple. Don't want to do anything too intricate. But then when a due diligence comes in and they start honing in on that and start asking a bunch of questions, there might be some issues or items that were not considered. So we do offer transfer pricing. We do anywhere from just looking at your transfer pricing policy to make sure it makes sense to going ahead and helping you guys write up a transfer pricing agreement in the US. But that is just an item that we're seeing the past few years really be honed in during due diligence. So if you are looking to go sell, maybe consider looking to make sure there's no issues there. Any questions? Yes. I'm s- I'm sorry, can you, I don't know if I could hear you. Think they, yeah.
About R&D credits in terms of APRs, intellectual property rights.
Yep.
They are in Finland. They belong to Finnish legal entity,
Yep.
which has US-based legal entity. In the US legal entity, we have found employees, but no APRs. So, what to do in this situation?
Yep. Are those employees doing R&D? Are they sales employees? What are US employees doing?
Different types of work, including R&D. Right?
Okay. Yeah, so the R&D, you don't have to own the intellectual property. The US entity does not have to own the intellectual property. So if you do have employees in the US under that US entity that are performing R&D activities, even if it's going to the intellectual property over in Finland, you still can create R&D credits here in the US. It matters where it's being performed, not who owns the property. Does that make sense?
The place, physically, where it is. Okay.
Yeah, physically, yeah. So if they're in the U.S. performing it in the U.S., there is an opportunity for an R&D credit, even if Finland's performing R&D over in Finland, and that's where all the intellectual property is. As long as it's in the U.S., there is still an opportunity for that credit. Yeah, good question. Yeah.
Sorry, maybe this is going a step back, but you mentioned that there is a risk. You mentioned earlier that there's a risk of bullying the Finnish
Yep.
company, but which way around was it? You say the US holding company that owns the Finnish company?
Yes.
The other way. Is there a risk also if it's the other way around that you have a Finnish parent company that owns 100% of the US subsidiary? Is there some risk that the Finnish parent company could be somehow required to report something?
So they'll most likely report what's called a 5472, and that's just to report that intercompany transactions. That's just the informational filing. That doesn't create any tax or anything. It's just intercompany activity. But that's that $25,000 penalty form that should be being filed. There is, as long as there's not any U.S. investors above the Finnish entity, it won't be pulled in underneath. There are certain constructive ownership rules where it can flip entities, but as long as there's not any U.S. investors above that Finnish entity level, it doesn't get pulled in under the U.S. entity.
All right, thanks.
And so, yeah, that's why it's just good to understand your company structure and what the filing requirement is, because different things can trigger different filings, and just, yeah, understanding what that filing is, which we see companies coming to the U.S. all the time, so we're very familiar with analyzing the organizational chart. We know what questions to ask to where we're going to see issues, so we can kind of help you navigate that market. Yeah, good question. Any other questions? All right. Tariffs. All right. So I will give the caveat that we do not do any items with tariffs. We do have connections that do help navigate the tariff market, but I do think it is important. I think that's a big contention for businesses operating in the U.S. So I wanted to talk high level, really what's going on, and what tariffs are being acted, when and where, and then what does that mean? So last year, the U.S. enacted the International Emergencies Power Act, or the IEPA. The overview, it was really to target Canada, Mexico, and China. Other countries ended up getting pulled in, but the argument was that it was to target the influx of illegal aliens and illicit drugs and to combat global trade deficits. They imposed country-specific tariffs that were ranging anywhere between 10 to 41%. However, on February 20th, it went to the Supreme Court. A bunch of states got together, a lot of businesses got together, opened up a legal battle lawsuit with them, and on February 20th, they said, no, under that IEEPA Powers Act, the president cannot impose tariffs. So they got struck down. And when you hear about tariff refunds, this is what you're seeing. That's the Tariff Act, that if you have tariffs under that IEEPA, you have to check your import of records. But these are the tariffs that you're able to get a refund on as of today's date. Immediately after those tariffs got struck down, the president enacted Section 122 tariffs. There was just a broad 10% duty tariff on any companies that are importing to the U.S. that is not covered under a free trade agreement. It is supposed to address devaluation crisis for the U.S. dollar. Big question. It's going to legal battle. Big question on, since everything's so interconnected, can there actually be a devaluation crisis on the U.S. dollar? It expires after 150 days, so July 24th, but there is a current legal battle on whether or not this is going to be repealed. In addition to those tariffs, there's also Section 232 tariffs that expanding existing tariffs on U.S. imports of steel, aluminum, automobile parts, and then imposed tariffs on copper, trucks, wood, and then there are current investigations on whether they want to impose tariffs on the following items. There are other additional investigations under Section 301 that it gives the president authority to have the U.S. government go in and investigate trade practices or policies around the world. So there's currently 86 countries that are under investigation for unfair and discriminatory practices. That's really what they're trying to target. So really forced labor, excess manufacturing, and based off of those findings, they may impose additional tariffs once they should be done supposedly over the summer. So that's really high level what's going on with tariffs. I know that's kind of a interesting item that a lot of back and forth with stuff, a lot of news around it. So just wanted to talk high level just to give you guys an update. So with that, that is all I have. So here to help if you have any questions. Feel free to scan. You can connect on LinkedIn. I will say, unfortunately, I do not have a business card because of as the rebranding. David has my business card because they came in right after I left. So I unfortunately don't have business cards. So if you want to connect, connect with me afterwards. Once again, my name is Tyler Barton. You can connect me on LinkedIn. We also have Kylie Egendorfer here who can, we do have some availability on Friday too. So if you want to meet with Brent and Kylie on Friday, feel free to reach out to her, come and talk to her. We can get a meeting scheduled to answer any questions you guys might have. Perfect. Yeah. Yeah, absolutely. Yeah, we have contacts. It just gets into like a legal area that we kind of stay out of for right now. And so yeah, feel free to reach out and get you in contact with tariff refunds. Yeah, absolutely. Any other question? Yeah.
Anything more you can say about the transfer? Right? Aspect. So, what sort of okay, concretely for us, we have like a physical product, which is, and for now we do the full thing here.
Yep.
And we would basically just initially just have like small logistics operations essentially there, sort of packing it.
Yeah.
Customers. So, I mean, maybe some sales. So, kind of, what could it look like sort of in practice in this sort of setup? Like, can you? I mean, is it somehow like? Do they look at the costs of sales?
Mm-hmm.
Is there to sort of make a judgment on whether this is reasonable?
Yeah, and we do have a transfer pricing team that we can put you in contact with. At high level, it really looks at everything. Looks at what is Finland doing, what are the operations, what administrative items are they providing in addition to that product. And there's a thing, they look at certain ratios in the US. They just want to make sure that everything's being divided across evenly, right? Like they don't want you to, the idea is they don't want you to be The US does not want you to be transferring or taking too much of an expense here in the US to where is that really an arm's length transaction? So it depends on each entity. There's a thing called the Berry ratio where they look into that ratio of where that's being divided, and we can more than happy to make a connection with our transfer pricing team. We do anything from just taking a look at it and saying, hey, does this make sense? It's high level consulting, from going in and actually helping do a transfer pricing study. So we can have conversations, really help you however you need. We don't want to sell you something you don't need. Well, we can keep it as simple as possible. More than happy to do that as well.